All right, hello and welcome back to another episode of the Wealth Building for Dummies podcast. My name is Kyle Demian, and as always, I'm joined with Renji Matthew on today's episode. And today we're going to talk about how to create $1 million baby, how to set your kids up for future success. And we're going to talk about kind of like where to save your money and some different options as far as, maybe the 529 route, which you may have heard of before, or a lot of people now are talking about the IUL route and saving money through using that. But I think first and foremost, Renji, let's talk about like the importance of probably the greatest asset that children and young people have on their side, which is time. And can you just talk about the importance of, regardless what your plan is or where you save money, like why should people start saving for their kids when they're even newborns or, before the age of 5? Why is it so important?
Like you said, time. It's a compound effect is greater the longer you have, right? So the younger they are, the earlier you start, it's just no matter what you're saving for, at least it'll start growing earlier, right? And gives you more time with them because let's say you're setting up a retirement plan for yourself. We usually say if you have at least 10 years, you're good. But if you have more than 10 years, you're even better, right? What's that ancient proverb? The best time to plant a tree was 20 years ago. Second best time is now, right? So if you
Yeah.
have, the longer you have, the better, because it's just about compounding effect of that savings that you're putting aside. So today we'll talk about the 529 plan and we'll talk about the IUL. And uh, we're not really talking about which one's better. We'll just talk about pros and cons of both. And then you guys can decide what you think, and if you like the IUL and how it's set up, you can always hit us up and we can run those numbers for you and show you what it looks like for you or your kids. Me personally, I have an IUL set up for my son, and we'll talk about why I like it over the 529 plan. But yeah, let's go into it.
Perfect. And let's dive into it. Let's start first with a 529, because that may or may not be what people are more familiar with. But the 529 plan is its main primary purpose is for education savings. And with that, it allows you to have an individual account for you and your child. It's not through your employer. It's not through any particular company. You can set it up with just about any company that offers like an online brokerage. But a 529 plan, the reason it is called 529 is that section of the IRS tax code talks about how you can open an account where it has tax advantages if you were to use that money for educational purposes. So, for example, if your child goes to college in the state that you reside in, your contributions are after tax dollars. So you've already paid tax on the money when you put the money in. And then when you go to withdraw or use that money for higher education expenses for your child, that money can be accessed tax free. And in the meantime, between now and whenever they go to college, it's just like an account that's in the market because you can choose what it invests in. And based on what it invests in will determine the growth between now and let's just say age 18 when they're going to college and ideally looking at which colleges to go to, right? So those are some of the pros and the benefits of the 529 plan. Renji, anything else that you want to add on, or do you want to kind of start talking about like maybe some of the downsides that come with the 529 as well?
Yeah, I mean, there's a range of investment options, right? So it really depends on what your level of risk is, right? Because your 529 plan can be in protected accounts also, but most of the time people put it where it's subject to market volatility, which is why people do that because you want to have that growth, right? So the reason we like the IUL a little bit better is because you can have the same type of growth, but without the downside, right? But the problem is with the IUL, you can be subject to fees and stuff like that. But this is where setting it up the properly structured IUL comes into play. So most of the time, when we review people's policies, they're just not set up correctly, and that's why they get a bad rep. So if it's set up correctly, the fees and everything are not they're really minimal. And the way I see it, it's, what do you call it? If you're paying some kind of cost, what kind of value is it providing, right? So if I'm paying for that, what is the value that the IUL is providing for me? And in this case, the value is market protection and tax-free growth, right? So with the 529 plan and with the IUL, it's after tax dollars you're putting in. So their similarities are there. And you can use it both for education. But unlike the 529 plan, with because the 529 plan, if they use it for education, any type of higher education, it will be tax free. But if they use it for anything else, it can all be taxed, right? And with but there is a certain time at a certain age you can transfer up to, I think the limit now is 35,000 into a Roth conversion or something, but those could all change depending on the rules and laws by the time your kid gets to that age, right? So, but with the IUL, you can use it for whatever you want and it still stays tax free, right? And you get the market protection. So, what why you might be asking, why is that a big thing? Right? Something we talk about a lot on our channel is the volatility buffer and the break even burden, right? So with the break even burden, if you had 100,000 in there, which most of the time you're probably not saving enough to have 100,000 in there for your kids, but let's say, just to keep math simple, for simplicity's purposes, let's say you had 100,000 in there. If the market goes down 50%, you're at 50,000. Now, when the market goes back up 50%, a lot of people think you'll be right back up to 100,000. You won't, because 50% of 50,000 is only 25,000. So you only get back up to 75,000. So you have to go up 100% to get back to what you saved, right? So when you look at that, an IUL is so much better because you don't ever have to lose money, right? Especially if it's set up correctly. And it comes with living benefits if your child has any, God forbid, any types of chronic, critical, or terminal illness at any point after the policy is active. You can access that death benefit for paying any medical bills or anything like that, which the 529 plan doesn't have a death benefit added to it, right? So, like we said before, if you use it for anything other than education, it could be all penalized or taxed or whatever too. So those are some of the reasons. There's so many more things, and I could share my screen and show you some numbers. But is there anything you want to add or take away from that, Kyle, before I do?
I think just the only other ideas I had as you were chatting were the fact that, like, if you do go the IUL route, because it's going to be on a child, the costs are going to be so minimal because of the cost of insurance in general for life insurance increases as we get older and or we have ailments or diseases and disorders that start to become diagnosed. So, like, think of a child being young and typically in good health, their insurance is going to be the lowest that it'll ever be their entire life when they're 1, 2, 3 years old, right? And then also, I didn't hear if you touched on it, and if you did, correct me. But the one other idea that the IUL can help with is the fact that not everybody is going to go to college after they graduate high school. And what if your child wants to start a business, or what if they're in a trade and they don't necessarily need to go to college? Because at least in our hometown, like in high school, you can choose to go to like a high school that's only for trades. And when you graduate high school, like, you're ready to be in the workforce. I don't think that's necessarily across the country, but at least in my community, it is, and that's an option. That's a choice that people have. And so, what if your kids don't need that money for education? In a 529 plan, your option is to roll it over to a Roth IRA and into a retirement account. The problem with that, if your kid potentially needs access to the money, then is that there's a 10% penalty as well, a 10% penalty for using the money before the age of 59 and a half. Not only that, but the IUL gives you access to that money at any time without penalties, tax free. And then, yeah, God forbid, your child passes away too soon or has some medical, heart attack, stroke, cancer, a major medical event like that. Any of those circumstances, you're protected by the death benefit. And yes, they may not pass away anytime soon, and obviously that's what we hope for, right? But what's more probable or possible between your child and reaching the age of retirement is going to be like a major medical illness or event. And that's where the IUL can provide living benefits as well. So an IUL, simply to sum it up and to give like a definition, is an IUL is a life insurance plan with a cash value component that can be used for various different financial needs, including education, but not really limited to education, whereas that's what the 529 plan is. So with that, Renji, if you don't have anything else to add, or if you do, go ahead and then, yeah, let's go ahead and look at the numbers. If you want to share your screen, we should be able to do that here.
Yeah, and just to clarify, we're not saying a 520, I mean, an IUL is the way to go for everybody. We're just educating on the difference between the 529 and an IUL and why I chose an IUL for my son over the 529 plan. Because, like Kyle said, you could use it for anything. And because I'm a business owner and a serial entrepreneur, you could say, who's to say my son will grow up and do the same thing? I don't know. So this way it gives me the flexibility. So at the end of it, this is just educational. If you guys want to see it, it really depends on your financial goals, your risk tolerance, and how much flexibility and stuff you need. So at the end of the day, it's always good to look at both and see which works better for you. But with that, let me share my screen.
There
Yeah,
we go.
can you see my
Cool.
screen?
Yep.
Okay. So if you guys can see in this page, the different, and this is just an illustration I just made up on the spot here, but this is really similar to the one that I have set up for my son. Yeah, so if you guys can see the screen, on the right side, you see the face amount, which is also the death benefit, starts at 132. And this one you're putting in 250 a month. And then, like we said before, it's really depends on what you're looking for. And in this, we're looking for the cash value growth. So it's set up as increasing. So you want to be as close to the MEC level as you can without going over. So in this case, if we're putting in 250, the death benefit I have to start for is 132. But if you're going to put more, this could be higher. So my son is 5 now. This is how we set it up when we started for him. So we actually just recently took out about $1,500 from his policy to invest into something for him. But then that's the flexibility you have with that, right? You're the owner, so you get to control how you do it. So in this, by the time he turns 18, if the market only does 6.3%, he would have about 65,000, right under 65,000 in there. And that he can use for college. He can use, if I need to get him a car, I can use this for that. If he decides to start a business, he can use this for that. If nothing else, if he continues to use this, let's say if for retirement at 65, he would have, again, this is if the market only did a 6.3%, he would have almost 2.5 million in there. And he could take out about 235,000 a year for retirement. And again, this is just one example. There's flexibility in this because I can use it, continue to use it for him for retirement. I can use it for education. I can use it for a college, buy him a car, whatever I need to. And he could use it for a business. And at any rate, you're protected from the market volatility. It grows tax free, and the death benefit grows with it too. So he can use this for, if he, God forbid, if he has any type of chronic critical or terminal illness, he can access this at any time. So I'm going to stop sharing here. Anything you want to cover, Kyle?
Yeah, we talked about in the show. The name of the show is the $1 Million Baby, right? And so let's kind of talk about that. And you did $250 a month for your 3-year-old,
Mm-hmm.
and at age 65, he had, what was it, 2.5 million?
Yeah, right under 2.5. It was like 2.47 or something like that.
So like 2.4 million. And we've done and looked at the numbers enough that I think it's like what, $100 a month if you start with like a newborn. I think it's
Mm-hmm.
$100 a month until they're 65 would be what is necessary to create a $1 million baby. Have you looked at the numbers in a while or recently?
It's been a while,
Okay.
but I think you're right. It's around that.
I think it's really close. Yeah. But and that's the thing, like because they have 65 years, right? 62 years in your scenario with your son until they reach the age of 65, they've got so much, like think of it like a runway. They've got so much runway to gain momentum and to earn that compound interest over time that it doesn't take a lot to have a lot down the road, because if you start earlier, a little can go a long way with consistent savings and, just consistent compound growth all the time, right? So it can't be stated enough that, if we can, we should be saving for our kids. And these are just two of the options and two of the different ways to do it. One way is not going to be best for everybody, but
Yeah.
it's important to, know and understand what your options are and compare them for yourself to whatever you think may be best. Right.
Mhm.
And with that, Renji, is there anything else that you want to round up our show with for today?
Yeah, like Kyle said, it's not one size fits all. The purpose here is to we were talking about just educating on the difference between the 529 and the IUL. The primary goal, if your primary goal is to save for education, the 529 plan might be more suitable. But you got to think about what if the child decides not to go for education, right? And the flexibility is there with an IUL you have in terms of using the funds for whatever purpose. You have the tax free potential of no matter what you're using it for. But there also could be fees, and there are a lot of complexities that come with it too, right? So that's where you want to sit with someone that's an expert in it to set it up the right way. Now, the risk with the 529 plan is there is market volatility, right? Whereas with the IUL, you don't have that, and it comes with a death benefit. But again, it has to be set up correctly for it to work. Otherwise, 90% of the time when we review people's policies, they're just not set up correctly, right? And that's where the problem comes into play. And actually, I have a perfect example of this. I actually think it was like 2 or 3 weeks ago. I talked to a mom out in California who had someone set up an IUL for her son, who is 11 years old, for the purposes of education and stuff like that. But it was set up the wrong way, where she didn't have cash value in there till the 10th year. So that
Wow.
if it was set up that way, it's definitely not the right way to go. A 529 plan would have worked better for her, right? So again, it's not one size fits all. It has to be set up right if you're going to go to the 529 or the IUL route. Both options have tax advantages, right? So it just varies depending on where you want to go. And even like we said before, with the 529 plan, you can convert into a Roth IRA or later. There is a limit on how much you can do. Ultimately, the choice between both of them depends on what your financial goal is, what your risk tolerance is, uh, what your preference is between the flexibility and the taxes and stuff. But it's always good to sit with someone that's an expert to figure out what best fits for you.
Absolutely. And did we touch on the financial aid impact at all or no?
I don't think so.
Okay. The last thing we'll say too, the 529 plans are assets that are going to show up right on your financial aid application. So if you're trying to apply for any financial aid help in regards to your child going to college, 529 plan assets are going to show up right on that front of that form. And that can reduce or impact what kind of eligibility that you're able to get in regards to financial aid. In regards to it being inside of an IUL, those assets are not counted in financial aid calculations, and it's almost deemed as it's not an investment or not an asset that they can touch or use against you for financial aid. So keep that in mind. Hopefully, this information was educational and you got a lot out of it, and you start to have some ideas of how you could put your kids into a better position. Like Renji mentioned, this isn't financial advice. This is purely meant to be educational and for you to start to think of different ways to set your children up for a successful path right through college and one day to them getting to financial freedom in retirement as well. So hopefully this helped. If you guys got some good information out of this, make sure to click the like button, subscribe to our page if you aren't already subscribed, and also leave your comments below. Let us know, maybe what questions you have or any other topics you want us to cover. or let us know your thoughts on the 529 versus IUL conversation we had below as well. We are always here to help and always looking for extra insight and, thoughts and opinions from our viewers. So we appreciate you guys and hope everybody has a great rest of your day. Take care.